Welcome to another edition of Taking Stock for the week ending the 18th of July, 2025. I'm Trinh, Head of Research at Stock Doctor, and joining me today is our equities analyst, Charlie Song, to strengthen your thing share market. Welcome, Charlie. How are you today?
Yeah, good. Thanks, Ken. How are you?
Yeah, not too bad. It's quite busy actually as we head into reporting season with all these mining quarterlies. But just before we get started, a quick but important reminder: the information we provide today is of a generic nature and shouldn't be considered personal advice. Remember, shares are volatile, so any past performance figures aren't a reliable indicator of future performance. Well, Charlie, just before we start, you may have noticed a new addition to Stock Doctor. Prime Financial Group has officially joined the Stock Doctor platform, and here you'll find a suite of additional services, including financial planning, accounting, self-managed super fund administration, and investment advice. So feel free to explore the Prime tab on the Stock Doctor navigation bar. And if you have any questions, our team will be available to help. But let's now turn our attention to the markets. It's been quite a resilient week for equity markets, despite themes of sticky inflation and renewed trade tensions in the US. We had fresh inflation data, and that showed tariffs are starting to filter through to consumer prices, and that's prompted markets to dial back expectations for imminent rate cuts over there.
Yes. And in Australia, the rate expectations have also shifted sharply. Futures markets are now pricing in a 94% chance of a 25 basis point cut at the RBA's August meeting. That's been driven by data showing Australia's unemployment unexpectedly rising to 4.3% from 4.1% the month prior. That's the highest level since mid-2023. This is, of course, should benefit equities from an interest rate discount perspective, especially in the interest rate sensitive sectors like utilities and REITs.
Yeah, and speaking about the equities, let's now turn our attention to some company-specific highlights from our star stock portfolios this week, starting with wealth management platform operator HUB24. The business appears to be performing quite well, even surpassing net worth after reporting better than expected net inflows for the June quarter. So what's been the driver of this, Charlie?
Yeah, and if you can recall from our episode last week, we did speak about the differentiators of Hub compared to net wealth.
Hmm.
Despite it reporting lower ROE and profit margins, Hub24 has outperformed on flows due to its broader, more flexible platform, offering a wider range of managed accounts, private assets, and bespoke solutions via its private invest platform. Has appealed to institutional clients as well as dealer groups and independent financial advisors seeking greater control over portfolios. As a result, the business has benefited from large advisor group migrations more so than net wealth.
Yeah, quite interesting. They're coupled with strong market performance over the quarter as well. Funds under administration, they were also above market expectations. So this earnings uplift from this update is likely to be modest though, and it does reduce the risk of downside surprise when Hub does report in August, with return on equity forecast to expand to around 17.5% in financial year 25.
It's worth noting the stock is trading at a large premium to its fair value based on the consensus of 16 analysts. Hence, investors should consider trimming exposure, possibly locking in gains where portfolios are overweight.
Yeah, and moving on, Charlie, to billing software business, Hansen Technologies. Hansen upgraded its financial year 25 earnings guidance this week following stronger than expected operating performance and improved cost control. Importantly, though, its German billing software subsidiary, PowerCloud, if you can recall, they acquired this business not too long ago. PowerCloud returned to profitability earlier than anticipated.
Yeah, and Power Cloud has been a drag on Hansen's profitability since its acquisition of the business in 2021. You can see that clearly in Stock Doctor with the declining return on equity over the last number of periods. This was a key reason why we had to transition the stock to borderline star growth stock status. Whilst revenue guidance was trimmed slightly due to project delays, underlying earnings is now forecast at $110 to $112 million, a 15% uplift on previous expectations.
Well, that is quite a big uplift there, Charlie. But this upgrade does lead to positive earnings revisions, with return on equity now forecast to lift towards that 15% mark this financial year, and could potentially come back into our star growth stock universe. Recent contract wins, including the $50 million deal with VMO2, and new agreements across Europe and the US, also should help bolster earnings further. In this week's Under the Microscope segment, we turn our attention to global diversified miner Rio Tinto. Rio is both a star growth stock and star income stock in our portfolios, and has experienced some negative earnings revisions on the back of weaker iron ore prices. Charlie, how did Rio fare in its latest quarterly update?
While Rio delivered a mixed second quarter result, with copper equivalent output up 13% year on year, which was roughly in line with market expectations. Copper was the standout, driven by the ramp up in production at their Oyu Tolgoi mine in Mongolia. And there was steady output at their Escondida mine in Chile. Bauxite, which is primarily used to produce alumina for aluminium manufacturing, also hit a record production level. The weak aspect of the business, however, was the Pilbara iron ore output, which came in at the low end of guidance, but recovered following earlier weather disruptions.
Yeah, quite a mixed result there, Charlie. Even though iron ore still accounts for around or just over 50% of Rio's earnings, the results highlight the benefit of having a diversified exposure of other commodities as well. We had copper there, and that's performing quite well and becoming increasingly important, contributing around 15 to 20%. And then, of course, you have aluminium and bauxite making up around 20% of the business revenue. But meanwhile, lithium and titanium, they are starting to emerge, but they still remain quite immaterial for now.
That's right. And you might recall that Rio acquired Arcadium Lithium in 2024 for 6.7 billion US dollars, which represents around 4% of its current total market capitalization. As a result, the current uncertainty around lithium isn't having a material impact on the group's overall profitability. However, one area of concern is the impact of US tariffs on Rio's aluminium division, with the company noting that these added approximately $300 million in costs during the first half.
Yeah, a few risks there, Charlie, but there's also the risk along with the weaker iron ore price as well, which has contributed to that negative earnings revisions. However, following this update, we do believe that the dividend forecast that should remain intact, driven by the strong free cash flow from iron ore and also improving copper contributions as well. The fully franked dividend yield, currently at around 7.5%, should allow for some margin from that volatile commodity price.
Yeah, and interestingly, the short interest has fallen from 7.5% to 5.5% over the past 3 months, suggesting growing investor confidence as operational delivery improves. The incoming CEO, Simon Trott, is expected to sharpen the company's focus on operational excellence and capital discipline rather than pursuing major acquisitions. And this may help it maintain high levels of return on invested capital above 20%.
And now for question of the week. Following a raft of quarterly reports from the resources stocks, an interesting question for members this week is, what are the benefits and pitfalls of investing in resource stocks?
That's a great question, and one that is especially relevant if you are considering resource stocks in your portfolio. On the positive side, adding resources stocks to your portfolio can provide valuable diversification. Commodities such as iron ore, copper, and gold often move differently to traditional equities and bonds. During periods of inflation, for example, commodity prices tend to rise, providing somewhat of a hedge that protects the real value of your investments.
Yeah, and another benefit, Charlie, is the potential for strong capital returns and dividends, especially during commodity price booms. For instance, companies like BHP and Rio Tinto, they are generating significant free cash flow and may return much of that to shareholders. Additionally, top-tier resource companies tend to have lower cost of production, and having exposure to differing commodities also provides that buffer across volatile prices.
Yeah, but Ken, it's also important to recognize the risks.
Mm.
Resource stocks are inherently cyclical and are price takers. Their earnings are highly sensitive to fluctuations in commodity prices, which are influenced by global supply and demand, geopolitics, and economic cycles, usually factors that are outside of the company's control. During downturns, these companies can face sharp earnings downgrades, project delays, or even capital raisings just to shore up their balance sheets.
Yeah, and that's why, the outlook under Golden Rule 3, that can change quite quickly as well, despite the fact that some of these companies like BHP and Rio do have a lot of analysts covering their stock. Another consideration, though, is the capital intensive nature of the sector. Mining and energy companies, they often require billions in upfront investment to build projects with returns only realized many years down the track. So this increases the risk and exposes investors to uncertainties, including the operational setbacks and also higher costs, which can erode shareholder returns.
Yeah, and one specific example I would bring up would be mineral resources.
Mm.
That used to be a star stock, and now it's in financial distress, and it's only been a few periods. The reason why is even if a company relies on just two commodities, it can be at risk of large capital erosion.
Yeah, that's right, Charlie. And that's why we suggest investors treat smaller miners and those with single commodities exposure with caution and avoid those that are financially unhealthy as well.
Yeah, and that's consistent with our star stock approach. Resource stocks may have a place in portfolios, providing, again, a useful hedge against inflation, but they do need to be high quality businesses with strong financial health, low cost of production relative to their peers, and high quality assets. Given that they tend to be more volatile than other stocks, you also need to be comfortable with those risks and allocate your portfolio based on your own individual risk preference.
Yeah, that's right, Charlie. But I guess that's all we have time for today. And time just flies past when you're having fun. But that wraps up this week's edition of Taking Stock.
Yeah, and if you have any questions, please join us on Lincoln Live next Monday.
Yes, and with reporting season just around the corner now, it's a good time again to review your portfolio, focus on those financially healthy businesses, remain diversified, and have some cash on hand to take advantage of opportunities as they arise. Take care and have a happy, healthy, and prosperous week ahead.